So all the Fed is doing is building up the balance sheet. The asset side is being built up with bonds. They're buying bonds, buying bonds. And the liability side is being built up with deposits from the banks, which are liabilities from the Fed's point of view. So you're expanding the balance sheet, but the money's not going anywhere. All the QE money, $10 trillion, never went anywhere. They paid the dealers, and the dealers gave it back to the Fed. It was sterilized and never did anything. So was the money printing? Yeah, if you're using M0 to measure, but didn't do anything for the economy. It doesn't stimulate growth. Ben Bernanke was full of it. Jay Powell's a little more honest. Janet Yellen, she's kind of a affirmative action dunce. They didn't understand any of it, and it definitely did not work. Now, so why is the economy growing? I kind of painted a gloomy picture from the supply side and real incomes and a lot else, but the economy is growing. That shows up in GDP. Why is it growing? The answer is fiscal policy, deficit spending. That's completely different than monetary policy. That works because, well, it works. It works in the short run. It can be inflationary, but it works because when the government spends money, they're giving it to somebody. The money that the Fed created, they give it to the banks give it back. End of story. The money that the Congress spends, the deficit spending, it's going somewhere. It's buying weapons. It's going to food stamps or welfare or Medicare or Social Security checks or, the Green New scam or, a lot of it's kind of wasted, but it's going out into the economy. People are getting paid. Corporations are getting paid. They're paying their workers. That money actually does create growth.
In a recent discussion, finance expert Jim Rickards sheds light on the U.S. economy's liquidity crisis. Despite quantitative easing, QE efforts printing $10 trillion, the economy remained flat or declined from 2009 to 2019, with average annual GDP growth at a mere 2.2%. Rickards points out that the economy has been in a depression since 2007, characterized by depressed growth relative to its potential. While the Fed's monetary policy hasn't effectively stimulated growth, Rickards highlights the role of fiscal policy and deficit spending in driving short-term growth.
So QE, which doesn't work, by the way, they printed $10 trillion and the economy was flat to down. It was down sharply in 2000, but it was flat for the 10-year period from 2009 to 2019. So coming out of the global financial crisis in 2009 until COVID, which was 2020, but until COVID, 2019, that 10-year period, 2009 to 2019, average annual growth in GDP was 2.2%. 2.2. During the Reagan administration, 1983, 1986, the U.S. economy grew 16% in real terms. That was over 5% a year for 3 straight years. That's growth. That's what the American economy can do. And even if that's not totally sustainable, you should be able to grow 3.25%, 3.5% on a consistent basis. That's what a developed economy should be able to do. So 2.2% is pathetic. I mean, you can get out the pom-poms if you like, but that's really pathetic growth. That's what we had for 10 years. And my view is that the U.S. economy has been in a depression since 2007. And people say, well, wait a second, Jim, recession is 2 consecutive quarters of declining GDP. And that is the rule of thumb. It can last 3 quarters, sometimes longer, but they tend to go 6 to 9 months of declining GDP, 2 or 3 quarters. That's the technical definition of a recession, and it is. And so people say, well, depression must be worse than a recession. So if recession is 2 quarters, the depression must be 10 quarters of declining GDP. And we have not had that. But that's not the definition of a depression. A depression doesn't mean continual declines in GDP. It means below trend growth. It means depressed growth. And it was what I was just saying earlier. If growth potential is 3% and you're growing at 2%, that gap between 3% and 2% over time is trillions of dollars of lost growth. So has the economy been growing? Yes. It grew in 2023 and into so far in 2024. But it's depressed growth relative to potential, and that's what a depression is. And if you want an example, just look at Japan. I mean, Japan has been in a depression since 1989. Well, really 1990, December 31st, 1989. They rang the New Year's Eve bell, and then boom, the stock market fell out of bed. It declined, I think, 75%. It just got back. By the way, about a month ago, the Nikkei index just got back to where it was in 1989. So, which is about 40,000. So, nice going, guys. It took you 34 years to recover your meltdown. And that's all they've done is recover it. It hasn't gone up much since then. But Japan has had 9 recessions since 1990, 9 technical recessions. Well, you can chart the recessions, but I call it one long depression. It's a 34-year depression. And I would say the U.S. has been in a depression since 2007. So that's, 17 years. And we got 17 more years to go. But that's why everyone's out of sorts. That's why real incomes are not going up. That's why income distribution is, the rich get richer, as the saying goes, and they do. And everyday Americans are falling behind, and the middle class is getting wiped out. So, but you can still look for a technical recession within that time series. So, but getting to your point, Matt, QE. So QE doesn't work. You talked about government spending and deficits. That's correct. That's fiscal policy. So QE is monetary policy. That's what the Fed does. And deficit spending is fiscal policy. And that's what the Congress does. So all the Fed is doing is building up the balance sheet. The asset side is being built up with bonds, or buying bonds. And the liability side is being built up with deposits from the banks, which are liabilities from the Fed's point of view. So you're expanding the balance sheet, but the money's not going anywhere. All the QE money, $10 trillion, never went anywhere. They paid the dealers, and the dealers gave it back to the Fed. It was sterilized and never did anything. So was the money printing? Yeah, if you're using M0 to measure, but it didn't do anything for the economy. It doesn't stimulate growth. Ben Bernanke was full of it. Jay Powell's a little more honest. Janet Yellen, she's kind of a affirmative action dunce. They didn't understand any of it, and it definitely did not work. Now, so why is the economy growing? I kind of painted a gloomy picture from the supply side and real incomes and a lot else, but the economy is growing. That shows up in GDP. Why is it growing? The answer is fiscal policy, deficit spending. That's completely different than monetary policy. That works because, well, it works. It works in the short run. It can be inflationary, but it works because when the government spends money, they're giving it to somebody. The money that the Fed created, they give it to the banks give it back. End of story. The money that the Congress spends, the deficit spending, it's going somewhere. It's buying weapons. It's going to, food stamps or welfare or Medicare or Social Security checks or, the Green New scam or, a lot of it's kind of wasted, but it's going out into the economy. People are getting paid. Corporations are getting paid. They're paying their workers. That money actually does create growth.
Jim Rickards dives deeper into the U.S. economy's fiscal challenges, highlighting the stark reality that monetary policy isn't effective while fiscal policy comes at a high cost. Despite some growth in GDP, the debt is outpacing it, leading to a concerning debt-to-GDP ratio exceeding 130%, the highest in U.S. history. He explains how, at lower debt levels, borrowing and spending can fuel economic expansion. But as the debt-to-GDP ratio climbs, the effectiveness of this strategy diminishes. Rickards warns that reaching a tipping point where each dollar borrowed generates less growth poses significant risks to the economy's stability.
Now, but there's another problem associated with that. So the short answer is monetary policy doesn't work. It's a joke. We follow it, we report on it, but I'll tell you as an analyst, it's a joke. Fiscal policy does work, but at a very high cost. And here it is. So the U.S. economy in the fourth quarter of 2023, and we're seeing something similar in the first quarter of 2024. We won't have that data for a couple more weeks, but it looks like it's growing about 2.4%, 2.5%, which, it's low compared to potential, but it's decent growth. But how much is the debt going up at the same time? The debt's going up faster. The debt's going up like 3.5% on an annualized basis. So are you running deficits? Yes. Are you getting some growth? Yes. But the debt is going up faster than the growth. And so this shows up in a measurement called debt to GDP. Because people throw around big numbers, and they are big numbers. $37 trillion of national debt. That's about right. But you can't really make sense of that number unless you put it in the context of the size of the economy. I always, simple example, if you owe $20,000 on your MasterCard. Is that a lot or not? Well, if you make $20,000 a year, it's a lot. You're probably going bankrupt. If you make $500,000 a year, you can just write a check. And so you can't really learn much from the number, from the size of the debt. You have to compare it to the size of the economy. So what's that number? Well, that number is it's over it's over 130% right now, which, by the way, is the highest in U.S. history. That goes back to the late 1960s, so it's a good time frame. The last time, by the way, the number we have today, 130%, a little bit higher, is the highest in U.S. history. The last time it was even close was the end of World War II. It was about 120%. Today, it's about 132%. So it's the highest in history, highest at the end of World War II. But even in World War II, I like to say, well, we won the war. Yeah, we spent a lot of money. We ran up a lot of debt, but we won the war with our allies. And the U.S. was a global hegemon. Our percentage of global production, global capacity, automobiles, like whatever, it was off the charts. And we had a long run as the superpower. Today, we've got a higher debt to GDP ratio, but we haven't won any wars lately. We're losing on Ukraine, losing in the Middle East. No one really respects the United States. We've got brain dead leadership, et cetera. So we're not getting anything for our money. We're wasting the money. But it does have that effect I described. But the problem is, at lower levels of debt, so let's say the debt to GDP ratio, look at 1980, for example, 80, 81, around there. It's about 30%. Yeah, it's a really good, okay, so 81, 30%. So that's when Ronald Reagan was sworn in. The beginning of 1981, he was sworn in. That was the low. That was the lowest since World War II. I said it was 120% at the end of World War II. Yeah, but it was 30% in 1981 when Ronald Reagan was sworn in. So how did you get from 120% to 30%? Because we had a lot of deficits. There were some surpluses, but mostly deficits during that time period. Well, the answer is we grew the economy. The debt went up. It's not that the debt went down. The ratio went down. Even as the debt was going up, the economy was going up faster. So it's seventh grade math. If you have a numerator and denominator, if the denominator is growing faster, the denominator is GDP. If the denominator is going faster than the debt, then the ratio is going down. What we have now is the opposite, where the numerator is growing faster than the denominator. The debt is growing faster than the economy, which means the ratio is going up. So at a certain level, and by the way, the level is around 90% debt to GDP. So where do we hit? We hit 90%, it's around 2012. Yeah, there it is. Okay, 2010. Welcome, Obama. So below 90%, here's what happens. You borrow $1, you spend $1, and you get more than $1 of growth. So you borrow $1, you spend $1, and you get $1.25 of growth. That's actually good. Assuming you don't waste the money, that's a separate issue. But as long as the growth is greater than the debt, then your ratio is going down and your economy is solid. But as you get closer to 90%, that payoff, that called the Keynesian multiplier, gets smaller. It starts to shrink. So you start out when you're down around where we were in the 80s, even the mid 90s. You borrow $1, you spend $1, you get maybe $1.25, but then it's like $1.20 and it's $1.10, and then as you get higher and higher, as you get closer and closer to 90%, it shrinks until you get to a point where you borrow $1, you spend $1, and you get 90 cents of growth. You don't get your dollar back. You don't get the dollar of growth. You get maybe 90 cents. Now, it's still growth. It's still growth. Somebody got paid, somebody got a job, etc. But your debt's going up faster. And as it goes up even higher, that multiplier, which is once it goes below 1, you're digging yourself into a hole.
Today, we've delved into the nuances of monetary and fiscal policy with Jim Rickards, uncovering critical insights about the U.S. economy's challenges and the impact of government spending. Despite efforts like quantitative easing, Rickards argues that monetary policy falls short, while fiscal policy, although effective, comes with a hefty price tag. As we reflect on the data presented, it's clear that the U.S. economy faces significant hurdles, including a growing debt-to-GDP ratio. Remember, Understanding these complexities is crucial for navigating today's financial landscape. If you found this discussion informative, don't forget to subscribe to our channel, like this video, and share your thoughts in the comments below.